Welcome to the ultimate 15-minute professional masterclass on trading S&P 500 stocks. Today, we aren't just skimming the surface. We're building a comprehensive, institutional-grade trading plan from the ground up. This video is designed to provide you with a structured, repeatable framework that removes the guesswork and emotion from your daily trading routine. By the end of this session, you will understand the deep mechanics of support, resistance, and volume, and how to apply them to the world's most liquid stocks. This is the difference between gambling and professional speculation. We will focus on four market powerhouses: Apple, Nvidia, Tesla, and Microsoft. These stocks provide the liquidity and predictability required for consistent day trading. By the end of this 15-minute session, you will have a repeatable, structured plan that beats emotion every single time the market opens. You will learn to see the market not as a series of random price movements, but as a clear conversation between buyers and sellers. Our strategy is built on three unbreakable pillars. First, support and resistance, the map of where the big money has placed its bets. Second, volume, the fuel that tells us if a price move is legitimate or a trap. And third, risk management, the shield that protects your capital from the inherent uncertainty of the markets. Most traders fail because they only focus on the map. Professionals focus on all three. Throughout this masterclass, we will see how these pillars interact to create high-probability setups. Remember, price is just a suggestion until volume confirms it, and no setup is a good setup if the risk-reward ratio doesn't make sense for your business. Let's dive deep into Pillar 1. Support and resistance are the institutional footprints. We map these zones on the 1-hour time frame because that's where the macro players, the banks and hedge funds, operate. They don't care about the 1-minute noise. They care about levels where they can fill multi-million-dollar orders. A valid zone requires at least 3 clear reactions. These are rejections that prove the market agrees on the value of that price level. When you see price return to these 1-hour zones, you are looking at a high-probability battleground. Your job as a day trader is to wait at these zones and join the winner once the volume confirms the direction. If a level doesn't have at least 3 touches, it's just a line on a screen. If it does, it's a zone where money is waiting to move. Mapping these zones every morning is your first duty. The second pillar is volume, the ultimate truth teller in the market. Every other indicator lags behind price, but volume shows you the actual transactions happening in real time. Price movement without volume is like a car with no gas. It might roll, but it won't go far. We look for surges in volume that represent institutional commitment. When price hits your 1-hour support zone and you see a massive spike in volume bars, that is your signal that the big players are defending their positions. Conversely, a breakout through resistance on low volume is almost always a bull trap designed to take retail capital. Professionals use volume to validate every single entry and exit. If the volume isn't there, the trade doesn't exist. It's the only way to distinguish between a real change in market sentiment and a temporary pullback. Mastering volume analysis is the single biggest leap you will ever take in your trading career. Let's look at a real-world application with Apple. Every morning at 8:30 a.m., we mark the previous day high and the previous day low. Notice this 1-hour support zone at 185. It's been tested multiple times this week, making it a level of extreme interest. When the opening bell rings at 9:30 a.m., the volatility is huge, but we wait. We don't trade the opening drive because it's the playground of algorithms and emotional retail traders. We wait for Apple to reach our 185 zone. At 10:15 a.m., price touches the zone and forms a green hammer candle. But look at the volume. It's 200% higher than the previous bars. This is our signal. We enter long at the close of that candle, placing our stop loss just below the zone. Our target is the 1-hour resistance at 187. By waiting for this specific setup, we've eliminated the noise and traded alongside the institutional flow. This is the patience required for consistent success. Nvidia is our primary vehicle for momentum. Because of its high beta, NVDA provides some of the cleanest breakout setups in the S&P 500. On this day, we saw NVDA coiling under a major 1-hour resistance level for nearly 90 minutes. This coiling action is like a spring being compressed. When it finally breaks, the move is explosive. The breakout happened on a massive volume spike, but as professionals, we don't chase the high. Chasing leads to poor risk-reward ratios. Instead, we wait for the retest. Price comes back to touch that old resistance, which has now become new support. Notice the low volume on the pullback. This proves that the sellers have exhausted their supply. As price bounces off the line with a strong green candle, that is our low-risk entry. This setup allows you to catch the momentum of a stock like NVDA, while keeping your risk under absolute control. It's the hallmark of a high-probability trending market. Tesla is a volatile stock that perfectly illustrates our third pillar: risk management. Not every trade is a winner, and accepting that reality is the first step to mastery. In this example, we saw a clear bounce at support on TSLA and entered with our standard 1% risk. However, the market sentiment shifted, and Tesla broke straight through our zone, hitting our stop loss. Why is this a successful trade? Because we exited exactly where we planned. A trader who can't take a small loss will eventually take a catastrophic one that ends their career. By respecting your stop loss, you are protecting your capital for the next high-probability setup. In this masterclass, we view a stop-loss hit as just another data point in our business ledger. We don't get angry, we don't revenge trade, and we don't hope. We simply move on to the next opportunity or stop for the day if we've reached our limit. Protecting your mental capital is just as important as protecting your financial capital. Stay stoic. Microsoft often provides the cleanest trend-following opportunities for those who prefer steady, reliable gains over extreme volatility. Here, we see MSFT holding above its 1-hour support and respecting the 9-period EMA throughout the entire session. Instead of looking for a single massive reversal, we look for base hits. Every time price pulls back to the EMA or a horizontal level on low volume, it's a low-risk entry to join the existing trend. This strategy reduces stress and builds your account balance with high consistency. We manage these trades by moving our stop to break-even once we reach 1R profit. This effectively makes the trade risk-free and allows us to hold for our final target at the 1-to-2 or 1-to-3 ratio. Taking partial profits at key levels along the way ensures that even if the market reverses, you walk away with a win. Professional trading is about managing the downside first. If you protect your capital, the profits will take care of themselves. Microsoft is the perfect stock for mastering this trend-following mindset. To gain a professional edge, we must look at the auction market theory through the volume profile tool. This isn't just volume over time, it's volume at specific price levels. A high-volume node represents an area of high agreement, where price is likely to stall. A low-volume node is an area of rejection, where price will move very quickly because very few shares were traded there. By combining these volume insights with our 1-hour S&R levels, we can predict where price is likely to accelerate with incredible accuracy. You can see the real value of a stock. If price is above the value area, the regime is bullish. Below it, it's bearish. This is the same data institutional algorithms use. Mastering the volume profile turns the chart from a flat line into a 3D map of market interest. It's the X-ray of the market's inner workings. The point of control, or POC, is the single price level where the most volume was traded during the day. It acts as a magnet for price. Notice how often a stock is attracted back to the POC or finds support exactly on it. We treat the POC as a super level in our analysis. When price approaches a POC that aligns with a 1-hour support zone, that is a high-conviction setup that we never ignore. It's the ultimate confirmation that we are trading where the real money is concentrated. Using the POC helps you identify exactly where the market is most likely to stall or reverse. It allows you to refine your entries and targets down to the cent. This level of precision is what separates a retail gambler from an institutional-grade trader. Incorporate the POC into your daily routine and watch your win rate soar as you stop fighting the natural gravity of the market. This is precision trading at its finest. Beyond individual stocks, a professional must understand market sentiment through the VIX, the fear index. The VIX has an inverse correlation with the S&P 500. When the VIX is spiking, it means fear is high and stocks are likely to drop or become extremely volatile. When the VIX is falling, it indicates a stable, bullish environment. Before taking any trade on Apple or Nvidia, we check the VIX. If it's skyrocketing, we tighten our stops or stay on the sidelines. If it's trending down, we have more confidence in our long positions. Understanding this macro context is vital. You can have the perfect setup on a stock, but if the VIX is signaling a market-wide sell-off, your setup is likely to fail. Professional trading is about looking at the big picture and the small details simultaneously. The VIX is your early warning system. Respect the fear index, and it will save you from countless losing trades. Knowledge is power, and market sentiment is the most powerful force of all. The hardest battle in trading is not with the market, but with your own mind. Your brain is naturally wired for survival, which means it's wired to avoid losses at all costs. This instinct will make you hold on to losing trades too long and take profits too early out of fear of a reversal. To succeed, you must become a stoic. You must detach your self-worth from your P&L. Every trade is just one data point in a sequence of 1,000. If you followed your rules perfectly and lost money, that was a successful trade. If you broke your rules and made money, that was a failed trade. Focus entirely on the quality of your execution, not the outcome of the individual transaction. When you stop caring about the daily fluctuations of your account and start caring about the perfection of your process, you have truly arrived as a professional. Control your emotions, and you control your future. Detachment is the ultimate weapon of the elite trader. Patience, discipline, and stoicism are your keys to freedom. Your trading journal is your most valuable asset. It is the only true coach you will ever have. You must document every single trade with screenshots, entry details, and most importantly, your emotional state at the time. Were you anxious? Did you skip the retest because of FOMO? Over months, your journal will reveal patterns you never noticed. It will show you exactly which stocks you trade best and which setups have the highest win rate for your personality. This data-driven self-awareness is how you evolve from a retail gambler to a professional speculator. If you aren't journaling, you aren't trading. You're just clicking buttons. Real growth happens in the review of your mistakes, not just the celebration of your wins. Treat your journal like a professional business ledger. Review it every weekend to refine your edge for the coming week. Your edge is not in a magic indicator. It's in the data you collect about your own performance. Evaluate, evolve, and excel. This is the path to mastery. To finalize this 15-minute masterclass, let's review your complete routine. Step 1. 8:30 a.m. Pre-market preparation. Map your 1-hour levels and check the market sentiment via the VIX. Step 2. 9:30 to 10 a.m. Observe the opening volatility. Do not trade. Let the zones prove their validity. Step 3. 10 a.m. to noon. This is your primary execution window. Look for your support bounces or breakout retests only with volume confirmation. Step 4. 4 is adaugă p.m. daily review. Log every trade into your journal and prepare for tomorrow. On Saturdays, perform a deep weekly review. Look at your win rate, your average RR, and identify your top recurring mistakes. This feedback loop is the secret to consistent equity growth. Stick to this routine religiously. Trading is a business of habits. Small, disciplined actions every day lead to massive results over time. Consistency beats intensity every single time. Build your routine, and your routine will build your wealth. Stay disciplined. You now have the full 15-minute professional blueprint for S&P 500 trading mastery. Success is now entirely up to your discipline. Don't try to get rich today. Focus on being a better trader today than you were yesterday. If you follow this strategy with rigorous risk management and data-driven analysis, the results are inevitable. Thank you for joining this comprehensive masterclass. If you found value in this deep dive, subscribe to the channel for more technical analysis and professional trading strategies. Remember, plan your trade and then trade your plan. I'll see you in the next session. Good luck, stay disciplined, and stay profitable in the markets. Your journey to professional freedom starts with the next bell. I'll see you soon. Stay focused and trust the process.